Hello guys and welcome to another video. My name's Mark, I'm an entrepreneur and property investor, and in today's video, because I've got £3.5 million worth of property, £1.7 million worth of debt, the mortgage crisis video is particularly pertinent to me. So today, what I want to do, I want to give you a new level of transparency. I've brought with me one of my mortgage completion statements. I've just completed on this mortgage on the 3rd of November, so last week, and I want to go through that with you. I also want to give you some insight on mortgages I've got coming up, because in 2023 I've got one mortgage to do, and that is in February, so we've got to start thinking about that now. And in fact, I've gone ahead and arranged what I'm going to be doing with that, so I'm going to share that with you towards the end of the video. Now, before we get into all the data, if you wouldn't mind giving this video a big like, it really does help me out with the algorithm. And if you haven't already subscribed, why not consider subscribing? We have our subscriber dividend portfolio where we give you guys the dividends from that portfolio every single month. It's currently sitting, actually I've put another £1,000 in since there, so it should be about £3,500 at the moment. And hopefully at the end of this month, we'll be giving away whatever dividends come from that, and every single month I'm going to increase it by another 1,000. It just allows you guys and me to share in the journey of creating some passive income. So let's get into the video though, and let's start talking about the mortgage crisis and what's going on there. Because in 2021, everything was rosy for mortgages. I was getting rates at less than 2% on a 2-year fixed. I was getting them at 3% within a limited company. Remember, if you're doing a mortgage, generally speaking, in your personal name, it's almost always cheaper than in a limited company. So 2% in my personal name, 3% in a limited company was very, very standard for me. And the way that I really run my refinances tends to be along these lines. I'll buy a property, I'll do some work, or I'll have bought it at a discount. 2 years later, I'll refinance it. So I'll initially buy it on a 2-year fixed, and then 2 years after that, I'll get as much of my money out as I possibly can, and I'll put it on a 5-year fixed. And the reason I put it on a 5-year fixed afterwards is because at that point, I know the only way that value is going to go up is if the market moves it. So I've already added as much value. Let's give you a real live example. I bought a flat for 160,000. It was probably worth 180 when I bought it. I negotiated a good discount. Now let's say, for example, after 2 years that became worth 200,000. Well, at that point I can get out almost all my money. I'd be about 45, 50,000 into that with all the fees and everything else, and I'll be able to get out about 35. But after that, I really am dependent on the market, aren't I? The 20,000 that I saved here, that was me being able to negotiate it. But afterwards, only the market is going to save me. And because the market moves at 3 to 5% a year, it's going to take a while. So in order to save on fees, which is one of the biggest destroyers of wealth, these fees, and we'll go through that in a minute, I tend to then put it on a 5-year fixed, knowing in 5 years the capital appreciation on that should make it worthwhile refinancing. If you can imagine, after 2 years, if I'd only added £10,000, so on 75% I get £7,500 out, well, I've probably got to pay £3,000 or £4,000 in fees. It's more than half of it gone. It's just not worthwhile. So I normally do a 2-year fixed followed by a 5-year fixed. That said, what's going on at the moment has completely changed my strategy, and I'm going to go through that in a minute, trust me. So I managed to secure a rate of 3.74% fixed, and it's a 2-year fixed. So that's £406 a month based on a £130,000 mortgage. Really, really good. And I got that right at the end when you can get what I would consider relatively cheap rates, 3.75%. We agreed it in August, and now we've completed on it in November. So that's pretty standard. You get the offer, and then a couple of months later you complete on it. Back in August, 3.5%, 4%, that's what you could get. Today, it's more like 6, 7, 8%. So this is the reason that I'm not so keen on fixing today. So in this video, one of the things I really wanted to focus on was fees, because I think that that's one of the ways that wealth really does get chiseled away from people. Valuations, they typically range from £500 to £1,000. Arrangement fees, I mean, they can be fixed at a couple of grand, or they can go as high as 2-3% of the total mortgage value. So if you've got a £200,000 mortgage and it's a 2% fee, well, that's £4,000. And then beyond that, you've also got solicitors' fees. So if you're moving, I would say £750 to £1,000 worth of solicitors' fees. Very, very normal. So this is one of the reasons that that when we refinanced this deal with Fleet back in August, we stuck with the lender that we were already with. Now, they weren't offering any 5-year deals at the time, which is why it went back onto a 2-year deal. The 5-year had just been withdrawn from the market the day we were applying for it. So we were very, very tight on what we were going to do. And they were going to relaunch a new 5-year at a much higher interest rate. So we went for a 2-year on that occasion. It's away from my normal strategy of 2 and then 5, but as things change, your strategies have to change. And my new strategy is completely different, but I'll go through that in a minute. So fees, these are really against you, and you've got to be careful, because I think that once you start bringing in these arrangement fees, a couple of grand here, a grand here, a grand here, you're 5, 6 grand, just doing a refinance, well actually just rolling over with your existing lender, not having to pay a valuation, not having to do solicitors, having favourable arrangement fees. Let me see what the arrangement fees were on this. I think they were very cheap, if anything. Yeah, unfortunately it doesn't say on the paperwork, but I know that I think it might have been 0 arrangement fee, and there was no valuation fee because there was no valuation. There was no solicitor's fee because we weren't changing lender. So my fees on that were incredibly low. Now, what I'm doing moving forward, I've literally got one that's coming up, £230,000 worth of debt on a £400,000 house. And I'm going variable for the first time in my life. We had the option of a 7% fixed for 5 years, which would be my normal choice. I'd have actually normally done some capital raising on it, but to be honest, at 7-8%, I've not got the appetite for it today. So 230,000, I've actually decided that we're going to go with a variable, and this variable rate, in my opinion, is fantastic. The product essentially is 2% plus BOE. So that's whatever the Bank of England rate is, which at the moment is 3%. And again, unless you haven't been following the news at all and have no idea, the Bank of England have been steadily raising that in order to combat inflation. Now, what I'm doing by going on a variable rate is taking a bet on the fact that I think the Bank of England is going to have to slow down or maybe even reverse their policy of taking money out of the economy. And why do I think that? Well, today, only today, we've had a first announcement. Last quarter, the GDP shrank by 0.2%. I'm on the ground with the businesses I'm in. I can tell you it's shrinking this quarter as well. There's no question. So when this negative data starts coming through, the Bank of England are going to have 2 choices: continue to destroy the economy or reduce interest rates. I'm betting that they're going to reduce interest rates, but we will wait and see. So if we went back down to historic lows and went down to 0.5%, and I'm not saying we will, I'm not saying that at all, then my rate would become 2.5%. If the Bank of England raised the base rate to 5%, then my rate would become 7%. So if it goes up, I lose. If it comes down, I win. Now, there's one other thing about this deal that I'm going into, and that's it's a lifetime tracker, which means it's always 2% above Bank of England. And that means I don't necessarily have to ever refinance it again. It doesn't have an end term. I think it's 25 years, the mortgage. So in 25 years' time, I'll have to look at it. But let's say, for example, I don't want to do anything else other than cash flow this property. Well, I've got no more valuation fees to do. I've got no more arrangement fees. I've got no more solicitors ever again. So there's lots and lots of benefits to this. But this, for me, would mean moving lender. And because of that, there are fees in the first instance. So let's have a look at those fees and see how it stacks up for me on this deal. So yeah, here we are. We've got 238,000 and the fees on it are going to be £4,764 arrangement fee. I told you fees are nasty and they do eat away at your wealth. But bear in mind, this might have to be the last time that I add fees to this loan. £950 paid on application for my valuation, so it's £1,000, and a £250 application fee on top. And then, on top of that, we have our solicitor's fees, whatever they're going to be. My experience is that'll be £1,000. So I'm going to be in it for £6,764 in fees, or about 2% of the total loan, or 2.5%, something like that. So for me, the reason that this is really, really attractive is that once I've paid these fees, it's a lifetime tracker. I don't have to redo it in 2 years. I don't have to do it in 5 years. The arrangement fee was going to be about that on a fixed anyway. The valuation was the same, unless we stuck with our initial lender. And our original lender just doesn't have that many products at the moment. They do have, at the moment, a variable rate one that's not very competitive. You can see that on that email she's saying compared to foundations. But you know, the market's changing all the time. We're not going to jump, we are starting the process. But that does mean in a couple of weeks' time, Foundation might have changed what they're doing. We might get a better deal with our existing lender. But at the moment, it looks like for me, I'm going to be going for a lifetime tracker at 2% plus BOE. The other thing with this one is that there's no early repayment charges. So that any time I just want to skip out of this, raise some capital against the value of the property, do a fix, whatever it is that I choose to do, I've got no early repayment charges. So it's a really good product for me in the situation that I'm in. Now this is the only one that I'm going to have to make a decision on in the next year. I've got everything else, 2023 is done, and then 2024 onwards. So I've got a bit of time and a bit of breathing space. But on this product, I had to make a decision because it's a February change, and I think for us, the best thing is to go onto a variable and see what happens with the Bank of England. In terms of a percentage of my debt, it's a relatively low amount, about 15% of my loans. You know, I've got £1.7 million worth of debt, so it's about 15%. I'm pretty comfortable having that on a tracker, and I think, personally, I think the Bank of England is going to have to capitulate at some point and start reducing rates, especially if GDP starts going down quickly. So guys, that's what I'm doing. I hope you've enjoyed the video and I hope you've enjoyed the transparency. As I said, I wanted to show you the completion statement. I wanted to be as transparent as I possibly could. Give the video a like, subscribe if you haven't already, and I'll see you on the next one. Cheers guys.